Gold back test to argue for a pullback. Several times we've made the point here that historically, gold rarely goes up more than 2% in a day. When it does so, statistically, it was almost always 2 to 6% lower the next 2 weeks. Admittedly and happily, it hasn't done that in a long time.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and this is the Gold Fix for Wednesday, April 30th, recording about 7:58. The homepage, there are several stories there. The one front and center, Goldfinger and bond death, is an unlocked free post that describes the bond vigilante perspective on gold using historical perspectives, specifically the movie Goldfinger. It's actually pretty cool. It's a retrospective piece on Ian Fleming's work and how he came into writing Goldfinger, as well as what gold actually measures, meaning in the world of finance, it's either bonds or gold. And once upon a time, back when this movie was made, it was basically gold. So bond death, pun aside, is what we're dealing with right now. So there you go. That's a pretty good article. Top left-hand side, COMEX Death Watch. We're going to update you on that today. We're seeing some CTA information that tells us nobody really cares about the COMEX as much anymore. And then why the JPM report is a major signpost in gold's bull run. We stand by that. Okay, gold halfway through the woods. Let's do the markets first. 10-year yields are 4.15, down 1 to 2. The dollar is 99.39, up 20. S&P 500 is 55.40. Note, gold-dollar correlations are back. People are trying to remind us of them. It's almost like the S&P 500 is 55.39, down 18. The VIX is 24.83, 84, 85, up 70. Gold is on the lows of the session, 32.73, down 43. Silver, 32.21, down 67. Copper, 4.54, down, holy crap, 24 cents. That's 5%. God bless silver for hanging in there with all that. WTI, 60.34, down 15. Nat gas, 3.23, down 3. Bitcoin bucking the trend, up 995 and change. Palladium, platinum, 927, 969, down 8 and a change, down 8 and change, down 9 and change. Grains are mixed. Soy down 7 at 1032. Corn, 461, unchanged offered, and wheat bucking that trend a little bit, 526, up a penny and a half to 3/4. All right, so gold halfway through the woods, and we're looking at the screen going, okay, maybe it's not going to get out of the woods today, but we are going to touch on this concept. The other discussion was really about the reports that have come out over the past couple of days and some news items and some context, little geopolitical context. So very quickly, I want to do the other discussions first, right? JPM's 4,000 walkthrough and analysis. That's the whole report. And we think it's imperative that you look at it if you're wanting to figure out how we got here. So the Goldman report is discussed, the Bank of America report, how every bank pivoted from dollar correlations to physical demand, as well as touching on the bearish case that's just unfolding right now. China's Xi to visit Shanghai. That's a news item, and it's just another, dot in the regression analysis that China this time is different than China in the first trade war, meaning Trump would do things and you would hear nothing from China. This time, the pushbacks are coming immediately, and this is an example of that. Like, this is China going to Shanghai to, hold hands, but he's also projecting strength to the other BRICS because Shanghai is important, extremely important in future business in the Belt and Road and what have you. And in the context of, like, for example, yesterday, Trump basically said China's going to pay the tariffs, right? And that night, China released its own version of propaganda and basically saying, "Oh no, we're not. We're not going to bend the knee," which is, the English version of kowtowing, I guess. Um, anyway, the point is that win or lose, China has a tactical list of things they can do now. They're not just waiting, and they're pushing back. And you're seeing the effect of that in Japan and other Asian countries because, hey, Japan's got to live with these people, right? So Japan's like, listen, we're here and we're going to trade with them. So it might not be as easy to do as President Trump thinks. Next, COMEX Death Watch, trend followers, long gold, short oil, U.S. equity, U.S. Treasury positions. That's a combination of analysis on CTAs. If you've been with us for a long time, you know that in the beginning of the gold fix, CTAs were very important behaviorally because even though they're relatively small in the bigger picture, they had an outsized effect on gold and silver because of their percentage of market share and because of their tendency to herd behaviorally. And over the last, say, 2 years, their significance has decreased as the market has expanded to attract other followers, other people, I should say, not followers. And what we're noticing now is we're now at a point where, with this COMEX Death Watch, their volumes are decreasing in gold too. So not only is their footprint, not only is their effect smaller in gold, but their footprint is as well. And that could be the sign of a healthy market, meaning the market share of the CTAs decreases. They're not as important. They're smaller players in a bigger market. And normally I'd say that, but something's not right there. I feel like the liquidity is going east, and therefore the CTA business is going east. Anyway, next, Founders Bitcoin Resilience is on the radar. That's something we sent out yesterday, and we stick by that. There's an event coming up on May 10th, which we'll be speaking at. That's the Cornerstone Forum with luminaries such as Martin Armstrong, Tom Luongo, and others. We'll list them as time goes on, and we'll bring this further to your attention as it gets closer. Bloomberg analysis: U.S. buying just getting started. That's a very bullish sounding headline, admittedly, but it's not clickbait. The point is, if you've heard us say, if the ETF buying gets to where it was during COVID, where it was when the Ukraine war started, then that's another $600 onto gold, and that was when gold was trading 3,000. We're at $300 there, essentially. Okay. And so that's halfway there. But the ETF buying has not gotten to 300, half of that distance. So two things jump out at us. One, it's going to go higher than $600 if the ETF buying ever gets to that point. And two, where the hell are they? What's taking so long? Like, how much higher does it have to go before they get in? I mean, are Americans investment-wise that stupid? It's possible. But there's another factor to look at, and that other factor is the price of gold is so much higher. And with stocks dropping and gold going up, they don't want to spend. They look at gold as a luxury item in that sense. Some people do. I'm telling you, that's how it works. Okay, so let's get to the main event here. Gold back test to argue for a pullback. Several times we've made the point here that historically, gold rarely goes up more than 2% in a day. When I say historically, I mean pre-22. When it does so, statistically, it was almost always 2 to 6% lower the next 2 weeks. You can backtest it. It's there. Admittedly and happily, it hasn't done that in a long time. Now, you could make the case that gold just regresses to the mean more, and I would make the case that gold has been made to regress to the mean more. Similar to how silver never really got above the 200-day moving average. It got there and stopped and went down, and now it's above it. So everybody's backing off a little bit, but it's relevant. And there's a chart of the 200-day moving average as I've kind of rendered it. Uh, and the last three times, gold got 25% above it and what the market did. So moving on, continuing with the article. As such, all of gold, so remember the 2% correlation I was just talking about doesn't happen anymore, right? All right, so as such, all of gold's short-term correlation risk factors have been blown out of the water these past 2 years. But here's what one of Wall Street's best quants sees looking at some intermediate time frame correlation, the stuff that macro discretionary boys look at. And they have yet to be tested. Simply put, when gold gets too far away from its 200-day moving, I am putting it very simply here. Okay, there's more to it than this, than from its 200-day moving average. A retracement is frequently seen. Note, this is an addition. I wrote this today, as this post is a couple days ago. Since this analysis was presented, physical buying is likely to be in the market again between 32.50 and 31.75, underpinning things above 32.75. Thus far as banks buy in front of it, and we're trading 32.70 freaking 5 right now, as banks buy in front of it. While the chart that we're about to look at looks bad on a monthly basis, the initial shooting star type impulse that everyone said, oh, we're going to have a retracement, has been negated. It's done. It's not valid anymore. So the monthly chart looks like, crap. I'm not going to lie to you there. So we've seen this before, and while it's not bullish, it's not as bearish as it used to be. Now, gold is not out of the woods for a big retracement, but it's at least halfway through the woods now. So much more of that in premium. And I'll show you this in a chart when we get to that down below. Data on deck, PCE, GDP, NFP this week. Big week, right? We've got GDP coming out at 8:30. That'll be out in about 20 minutes. We may not even be online then. And we've got PCE coming out at 10 a.m. And we've got non-farm payrolls on Friday. I think GDP is probably going to get a lot of attention because of the differential between Atlanta and the rest of the Feds. Atlanta is like recession. But I think the thing that the Fed's probably looking at more is PCE. And they've already gamed out what they're going to do because PCE can be pretty much inferred from the other data that comes out earlier in the month. So there you have it. I guess we're going to look at non-farm payrolls. We'll see what the market does today. We got through that pretty quickly. All right, good. Then we'll spend a little time on the charts. There you go. All right, let's start with Bollinger Bands. It's time for Bollinger Bands, boys and girls. This is a market biding its time with potential to break out lower. Why do I have percentages there instead of... There we go. This is a market biding its time, but now on our radar. So over the next 3 to 5 bars, so that's the next 12 to 18 hours, gold could very well begin a very violent move. Now, as we stand right here, that's lower. Doesn't mean we have to go lower. It does mean, however, that if we break outside of either of those yellow lines over the next 4 to 12 hours, this market will probably run. So the trend is your friend below or above the line on a 4-hour settlement. So now going back to the 1 hour, all the way back to the 1 hour, and you can see a series of 1 hour. These are, if you're following Bollinger Bands, that's a sell signal. Didn't follow through. That's a buy signal, actually. Didn't follow through. That's a sell signal. Has yet to follow through. It might be a good place to get long after data comes out today if this market gets back up, say, above 32.84. All right, so you have a series of aborted, failed downside attempts on the 1 hour Bollinger Band. On the 2 hour, you have, my voice is cracking again. On the 2 hour, it looks like, oh, you're outside the Bollinger Band, be nervous. No, outside the Bollinger Band, but you don't have the exact information you need for me to explain this to you simply, but this is not a breakout, even though it's outside the band. Yellow lines have to move different ways. 3 hour, however, looks a little bit scary. You're outside the band, and this line is not coming down. So you're in the process of possibly getting a 3-hour break. This, I would say to you as a trader, this doesn't matter because this is what matters. And we're going to find out in the next couple hours. So if you want to be bearish, sell it below my dotted line and stop yourself out back in the yellow line. Or if you want to be bullish, see what happens at the end of this 4-hour period. So that's the Bollinger Band take. All right. This is the trading range. Now, this is the story. Here's the history. Here's the history lesson. In 24, there were frequent times, semi-frequent times on the daily chart where the market would make a high. I think I can find an old one. There was one in 24 that just really got me good. This one. Here's one of them. All right. So the market would make a high, right? Look like it was dying, and then it would find a spot that it would stop. And then I'd say, okay, if the market was going below, if the market got below here, we're really going to crap out. And then the next day it would open higher, and then it would, I mean, look at this, right? High, okay, another high, but let's call this the high that matters, but this one really matters, right? Comes off, stops, not really a level. Next day, opens there, goes higher. Next day, opens, goes lower, test it, runs away higher. Next day, test it, breaks a little bit again, runs away higher, and that's it. It's all she wrote. And then we started to run down. I'm not saying this is exactly that, but I'm saying a high followed by a sell-off and a ledge. Historically, these ledges end up rolling over and collapsing. But that didn't happen then. Frankly, I was under long, if you want to look at it that way. So here we are, a high. No reason at all to stop here. And I'm going to pat myself on the back and say I saw this one early. I go, here we go. I wanted to get bearish. You may remember I had 2 dotted lines here. The first one was my warning. This was my warning area, right where my cursor dotted line is now. Below there, pay attention. Below here on a closing basis, be bearish. And there's all kinds of nuance in between there. So here we are in between those 2 lines, the old one and the new one. Right? This is my level that basically says in between the dotted line that I just implicitly drew and the old dotted line, I think that's bullion banks buying. And I think they're buying for the same reason they've been buying for the last 2 freaking years. And that is the floor continually gets raised. Now, I stopped repeating that meme. The floor is getting raised. The floor is getting raised. Because at some point, the roof started getting raised, and I abandoned that. But this is the floor getting raised. All the physical demand that we used to have below, central banks are patient. They don't chase. Central banks are, maybe insurance guys in China are chasing a little bit. I can't tell. But whatever theory I have, there's one thing that's not a theory. Basel III implementation starts on July 1st. And while gold is really, really a small portion of it, and it doesn't really affect the futures market, it does. The marketplace itself is shrinking as a result of that because it's cash and carry now at the banking side. And I think all the gold is being pulled out of COMEX slowly over time and being put into products that people want domestically. Anyway, so that story aside, bottom line, I think the floor is being raised because there are physical players who wish to buy it, and those physical players who wish to buy it are forcing shorts to cover at higher and higher levels. Why the funds aren't getting long like they used to, I don't know, but I contend that it's COMEX death related. And there we are. We're trading down 34. See that? If I had just bought that, I would have made $6. Yeah, I could have lost $10, but you get the idea. That's it. One more. Let's bring silver up. For heaven's sake. Oh, God. That's not exasperation. That's actually happiness. Here's what I mean behind this. Look at copper today. It's down 26 cents. This is global recession stuff. Look at this. Look at this. Look at this board. Yields are up. Okay, not a lot. Dollar stronger. Okay, that's good. Meaning yields are up, dollars. Yields are down, dollars up. Stocks are down. Okay, nothing big. VIX firm. Gold down. Gold should not be down this much with this behavior going on. Okay, here's what I think. I do have an opinion now. I think all these people looking at the back test that we're describing to you and the bearish rhetoric and all that that's coming out about gold, I think they're placing their bets. Sorry, Silver, I'll come back to you later on. I think they're placing their bets. The analysis comes out when the market gets here, the bets start getting placed in here, and somebody keeps saying, I'll take it. You want to sell it to me? I'll take it. And now there's a battle. So this is a battle here. This is the big macro discretionary regression to the mean types playing short. And this is the physical buyers and probably the bullion banks front running them, trying to buy it. So there are several scenarios that can play out. I'd like to see this crack, go to here, find more buying, and have people just freak out and the market goes back up. But you never know. Back to silver. All right, we got to zoom out a little bit on silver because that's a tough chart to look at and make a decision. All right, so on a weekly, we start on a weekly and we say trend line, no big deal. You have to give silver a lot more latitude or leeway because it is precious and it is industrial. And look at this market. I mean, this is so good. I think right now there's probably industrial selling. It's an economic commodity. But with gold down, there's actually silver being bought. So silver's down 2%, but it's not where it could be. Like, let's look at copper today. Right? That's crazy, right? So anyway, copper's in a range on a weekly basis, right? Silver's not in a range, or put it this way, it's in a higher range. So considering on a weekly basis, copper is in the middle of a 3-year range. That's the industrial metal. Here's the precious metal, the hybrid they call it, is at a new range well above where it should be given where copper was. And gold, of course, is not in a range at all. It's going out on its own. So there you have it. And look at gold. Just look at gold go. There's buying there. The data is going to be out in 10 minutes. Let's see what happens on that. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. Sure hope you enjoyed the show and that it's helpful in unraveling the latest activity in the gold and silver markets. And real quick, before we wrap up, did have some news to pass along from Fortuna Mining, who was our proud sponsor of today's show. And Fortuna did have news out before the open as they have renewed their share repurchase program. That's something that they were active in last year. And that share repurchase program now has been renewed. Obviously something that Jorge Ganoza, CEO of Fortuna Mining, has talked about quite a bit in terms of strengthening their balance sheet, and that is one of the ways in which they have done that. Also, some other recent news that fortunately we'll get even more color on soon, because Fortuna did recently announce the sale of the Yaramoko mine in Burkina Faso and also completed the sale of the San Jose mine. And fortunately, they have earnings coming up. Will be released on the night of May 7th and hit the market on May 8th. And we'll be having Jorge join us for a call where we can take questions and dig into all those things. So that will be next Thursday. Of course, you can always find out more at fortunamining.com. And certainly it will be fun to see what the earnings look like with the once again elevated gold price in the first quarter. So again, that call with Jorge will be next Thursday, May 8th at 4:30 p.m. Eastern here on the Arcadia Economics channel. And we'll look forward to seeing you then. So go out, have a great day, and thanks for being here. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.